Declining inflation should allow central banks to eventually pivot to an easing bias. Recession seems likely and equity markets may struggle, but a global economic recovery should be on the horizon by the end of 2023. Hi, I'm Andrew Pease and I'm the Global Head of Investment Strategy for Russell Investments. Welcome to our Global Market Outlook for 2023. There is a Winston Churchill quote for every occasion, and the one that best sums up 2022 is, "If you are going through hell, keep going." It's been a hellish year for investors, and almost every major listed asset class has posted negative returns. The rebound over the past couple of months has provided some relief, but it's too early to be confident that we've seen the worst of the market conditions. The economic news is probably going to get worse. It looks like Europe and the United Kingdom are already in recession, and with the Fed having tightened monetary policy aggressively, a mild recession seems likely for the United States sometime next year. It's unclear when China can fully escape zero-tolerance lockdowns and the property market explosion. The exception, as always, is Japan, which hasn't had monetary tightening and where the inflation spike offers the opportunity to break nearly 3 decades of deflationary psychology. Markets, of course, are forward-looking and usually price in bad economic outcomes ahead of time. It is possible that we've already seen the worst declines in equity markets. This could be the case if the United States has a very mild recession in 2023. On the other hand, there is a chance that markets shift away from the current bad news is good narrative where soft economic data is applauded as it signals a shift away from Fed rate hikes. We may move to a bad news is bad scenario where fears of declines in profits and jobs lead to further market downturns. The only good news from a year where both equities and fixed income have delivered negative returns is that we are finally escaping the world of TINA, which stands for There Is No Alternative, where ultra-low interest rates forced investors into equities and a risky search for yield. Higher interest rates means that TARA, There Are Reasonable Alternatives, is now a better description of the investment opportunity set. The return of TARA means that the traditional balanced portfolio made up of 60% equities and 40% fixed income is poised to make a comeback after its worst year in living memory. A key issue for 2023 is whether inflation pressures ease by enough to allow central banks to step away from rate hikes and potentially begin easing. We expect inflation will be on a downward trend as global demand slows. This should allow central banks to eventually change direction and set the scene for the next economic upswing. Markets and economies move in cycles. There is no certainty that we've seen the market lows, but the contours of the next upswing are visible on the horizon. Let's turn to our asset class preferences. Our cycle, value and sentiment decision-making process points to an uncertain global equity market outlook. The possibility of recessions means that the cycle is a headwind for equity markets. This may, however, improve once it is clear that the Fed has finished tightening. The turning point will come when interest rate cuts are on the horizon. Our valuation methodology is scoring US equities as slightly expensive and non-US equities as close to fair value. Our composite sentiment indicator for equities has reached extremes of pessimism twice this year. Sentiment extremes tend to have a persistent impact on market psychology. Investor fear is positive for the outlook from a contrarian perspective, and we score sentiment as supportive for equities. This means that our cycle value and sentiment conclusion for equities is that the cycle is poor but may improve, value is expensive to its best fair value, and sentiment is still supportive. Government bonds are attractive from a cycle, value, and sentiment perspective. The cycle is turning supportive with inflation set to decline and with central banks potentially going on pause in early 2023. Value has turned positive after the rises in yields this year. Sentiment also backs a positive case for fixed income, data showing that most institutional investors are crowded into short duration positions where they expect bond yields to rise further. This is supportive from a contrarian perspective. 2022 has been a year to forget from an investment perspective, but it's important to remember that markets and economies move in cycles. The economic news may get worse as central bank rate hikes flow through the economy. Markets, however, will at some stage start looking ahead to predict the eventual recovery. The rise in interest rates this year means that TINA is being replaced by TARA, and that means that a diversified investment approach should be successful. Thanks for watching, enjoy the holiday season, and we'll talk again next year.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.